On August 24, 2015, the Dow Industrial Average plunged 1,089 points in the first 10 minutes of trading, the largest intraday point drop in the history of America's oldest stock index. That same day, it regained almost 1,000 points, only to slip again and close down 588 points, a volatile day in a turbulent stretch that has seen the market whipsaw. As an investor, you might feel nervous about market volatility, especially when the trend seems to be heading downward. But reacting emotionally is never a good investment strategy, so it may be helpful to consider the reasons behind the market swings and maintain a long-term perspective. What's at the heart of this volatility? 3 global concerns: economic weakness in China, low oil prices, and a strong dollar. At first glance, low oil prices and a strong dollar might appear to help the economy, not hurt it. After all, they're generally good for consumers. But they can hurt some multinational businesses and negatively affect the economies of our trading partners. An economic weakness in China can affect countries that depend on exports to China, which in turn can affect the global economy and potentially the US economy. Adding to the uncertainty is concern about when the Federal Reserve will raise interest rates. The Fed took a pass in September and October, but most members of the Federal Open Market Committee anticipate raising the benchmark federal funds rate this year or early next year, which would be the first rate change since December 2008, when the rate was set to near zero. Despite these headwinds, U.S. economic indicators bode well for the long term. Second quarter GDP growth was a healthy 3.9%, up from a previous estimate of 2.3%. Consumer spending drove the overall increase, but improved corporate profits also played a role. And despite initial third quarter GDP coming in lower than expected, the details were quite good. Although any market loss can be difficult to accept, it's important to keep the numbers in perspective. While the S&P 500 index lost 9% from July 20th to September 25th, it was still up over 185% over the last 6.5 years. Fleeing a market during a downturn is tempting, but it means you won't be in a position to take advantage of growth on the upswing, as many investors learned when they left the market during the last recession. As you plan your next move, it's wise to stick to the sound investment principles you've used in building your portfolio. Thank you for watching.